are listening to the NextGen Leadership Podcast. There is no substitute for work. Worthwhile results come from hard work and careful planning. John Wooden. Thank you for tuning in to the NextGen Leadership Podcast. Wow, your camera is really clear today. Oh, you look good, Jonathan.
Oh baby, 720 HD. Hope I don't have any zits because it's coming in clear today.
That's a great camera. We are up and running today. We got things figured out from a technical side of things. Thank you for tuning in and listening to us wherever you're listening to us, whether it's in the morning on a bus or in the afternoon on your way home from work. We're excited. This is probably going to be one of our favorite episodes so far that we've shot together. And Jonathan, we're talking about the process. Last week we talked about the goals involved with your 2022 and beyond and what that looks like in investing in baseball and everything like that. But now we're getting into the process, right? And diving a little bit more into how deep we can get into what it takes to get to those goals that you set for yourself. And not only in the process of baseball, but the process of life and investing in the game and in yourself and all those good things. So there's so much we can dive into today, but we want to keep it short and simple for you, get you some good points. And what pieces, Jonathan, for you, are you excited to talk to about when it comes to this stuff? I know you got a Warren Buffett chart in here in our show notes. You got all the good stuff that everybody likes to hear. But what pieces are you excited about? Excited to talk about today?
Well, I mean, if you're an athlete, or even if you're not an athlete, you've probably heard that phrase, right? Trust the process. So that's what we're going to dive into. Biggest thing with investing, it's just a long-term game. I mean, we're talking, decades and decades is really going to be the length of any individual's investment career. I mean, you're talking, you graduate college at 22, full retirement age is 67. I mean, that's a 45-year window of, work life and investing and saving to get to that point. Obviously, a lot of people would like to retire earlier than that. And if you do a good job and have a good process over a 30 or so year period, you can pull that off. But I think the biggest thing that we're going to kind of get into today is just, this is a long-term game. And if you can stay the course and just kind of do the day-to-day stuff throughout that process to get there, then you're going to be in really good shape.
Yeah, and there's the word that I first learned when I was like growing up, and I think we had some banker come in and talk to like our economics class or something like that in high school. I just remember him talking about the word compounding and how much time it takes for your money to grow. And if you give yourself more time, you can have success regardless of what you do. That was interesting to me because I almost applied that to baseball as well as money, investing in money and things like that. But this idea of compounding to me applied in so many different ways. Um, it's as again, it's this process, but compound interest, it's a simple topic, but not everybody listens to it and understands it. Talk a little bit about your pieces of what compound interest is, this true eighth wonder of the world, as you call it.
Yes, the true eighth wonder of the world is correct. For me, just a quick example. I mean, you can go on to any compound interest chart. They did this in our like business personal finance class in high school, but it's like you take $10,000, you compound it at 10% a year, which is about average for US stocks. 9.7 is the real number, but we'll just use 10. Over a 20-year period, $67,000. If you never add another penny, 20 years at 10%, you're at $67,000. Now you stretch that out another 10 years, you go to 30, it's $174,000. So you can see like it's kind of the exponential growth type thing. So the more time that you allow interest to just compound on itself, I mean, it is truly an incredible snowball effect. And you mentioned the Warren Buffett chart, so he's a prime example. I mean, Warren is pretty much considered the greatest living investor. There are people who have had better returns, but I mean, the length in which he's been able to produce, he's averaged over 20% a year, since the 60s. But the coolest part about this, and we'll link to this in the show notes, is his net worth is over $100 billion now, but over 95% of that has been created after his 60th birthday. He's like 91 now. So Well, he was a billionaire. He has been a billionaire for a long time, but he was worth like $2 billion in the late 80s. Now he's worth 110, 30 years later, because he's still continuing to invest and grow, but the number in which it's growing upon just continues to grow. And that's the power of compound interest, right? It's like if you make 10% on $10,000, now you got 11, right? But if you make 10% on $100,000, now you got 110. So you made 10 versus one. Make 10% on $1 million, now you made $100,000. So now you're at 1.1. So you can see, right, as that grows and compounds on itself. But then it's also, you make 10% on that 1.1 the next year. Now you made 110,000. So the numbers just automatically grow and compound on top of themselves.
I think a lot of guys forget too. Like I use the example of like, let's say you get your contract bonus, your signing bonus, from the draft or whatever it is, and they look at that money and they're like, "Wow, look at this! Like, it's $10,000 or it's $1 million, whatever that number is, right? This is a lot of money for a lump sum or a one-time payment. They might have never seen that much money before, and they look at it and like, hey, I can spend it right away, and I can use this money to pay off debt or do whatever it is, right? And unless you have a plan inside of that money, that's where a lot of guys run into trouble. I know, like, you think about the old statistic in like basketball where guys, you know, basketball players on average have the lower net worth than any other professional athlete because they had spent all their money and they weren't educated on how to use that money, right? And nowadays you see athletes with a lot of these big contracts taking a lot of that and putting that into investment accounts or putting that into working with a team and a financial advisor so that they prep them for almost a lifetime legacy. Now they might spend some of that money and use it for bills and life expenses and a cool car or something like that. But if they can set themselves up and they have, let's say, 8 to 10 million, and that's returning money on top of that, you're never going to touch that principal in retirement and when you're done playing your sport too. And that's another piece of compounding that people don't always think about, is allowing that money to grow, but then never having to touch that money again because you're able to fund a lifestyle that you can create outside of that. And that's a huge part of it as well. And I use the baseball example for the listeners because that's very common, but not everybody thinks about right away. They could take the instant gratification and be happy with that and then not realize that there's a future outside of it and not have that opportunity in the future as well. So
Yeah, that's the trade-off, right? I think that's kind of at the core of what financial planning is all about, that today versus tomorrow. In our financial planning software, we have kind of like goal cards and like priority cards where there's different things that you can prioritize. And for me, my number one priority in my plan is today versus tomorrow. Like I want to live well today, but I also want to make sure that I've got something set up on the back end to where whenever I can't work or I choose not to work, I'm still going to be okay, and I'm going to be able to live off of that interest and not really ever have to touch that principle. So that's it. That's a very good point. But it is the trade off, right? Where let's say you get $1 million, right? First of all, you got to pay the tax man, you got to pay your agent. So then you're really sitting on about a half. But then from there, it's okay. What do I want today? But what do I also want to do to set myself up for the future? Because kind of going back to that Warren Buffett example, like he is as wealthy as he is today because he was a millionaire at 30. Like he was a very wealthy individual at 30 years old because he started very young. I saw a story, he filed his first tax return at 13, right? So
mhm.
for an athlete in particular, where you get this very large amount of money, even if you sign for 125 grand as a 21-year-old, right? You're still one percentile. Like you are the top one percentile of anyone in your age group as far as wealth goes. And then even to be able to set aside a small amount of that, right? Like at 21 years old, going back to that $10,000 example, let's say you just set aside 10 grand, right? You just set aside 10 grand. You're 21 years old. You don't touch it for 40 years. Now you're looking at a $452,000 bogey that you got at age 61. You didn't do anything. All you did was just set it, put it in an index fund, and go. Right. So that's one of the conversations that I really have a lot with those young guys that do come into some sudden wealth. It's like, dude, you don't have to take a ton of this. Like I understand you've got expenses, but let's just take a sliver of this, put it aside, act like it was never there, and then we'll go back and touch it once you're 60, and
Yep.
you're gonna be really happy with what ends up showing up in your account if you just don't do anything. Just don't even think about it.
Yep. And that's the basics of it, right? We can dive into the pieces of where you're putting that money, whether that's in an IRA or a traditional 401k or an indexed universal life policy. I mean, you can put your money anywhere. Doesn't matter, right? But that's where we're employed to help you understand that role and help you understand what are the pieces of where that money goes and how efficient can you be from a tax standpoint and all of those good things as well. So if you're interested in talking about those pieces of it, where that money goes, that's where we dive into a conversation off the air and do that kind of stuff with you as a financial advisor. But another piece of that is 40 years is a long time, man. I'm only, I'm not even half of that, what feels like in my life, and not even close to something in retirement. So it's that aspect of, well, the market's down this year in 2022. I'm down big. I feel like I'm losing all my money. Do I pull out now and take my gains, or do I keep going? And what does that look like? What is the timing? How do I maximize my returns and get 20% a year? All these questions pop into my head. Um, Warren Buffett's the best one, right? And I'll let you kind of take over on that piece, but his quotes on timing and market and fear are things that are principle and understanding how this investing game works.
Oh yeah, yeah. You could. I mean, there. I literally got two books on my shelf that are just Warren Buffett quotes. Like
Yep.
I mean, he's got so many of them. But my personal favorite quote, just in general, is it's time in and not timing. Going back to making sure that you just let that thing grow and compound, right? Because the worst thing you can do as an investor is you jump in and out and you break up the compounding. Compounding needs to be continuous for it to be able to work. Um, so for me, the Warren Buffett quote that really sticks out is, if you're not willing to own a stock for 10 years, you shouldn't even think about owning it for 10 minutes. And I think that a lot of people who, especially young people, who just got into the investing game kind of during the pandemic and on Robinhood, following stock twits, doing the Reddit game, whatever. Like, I think that has warped the perception of what investing actually is. You buy it, goes up, you sell it, you make money, right? Like, that's kind of been the new school perception. And you've seen that, over the last 6 months with a lot of some of those names that were really popular during the pandemic. Peloton is a perfect example, down 80+%, where, if you don't have a plan in place, you're gonna be in a little bit of trouble. But you buy quality companies that have earnings. I don't know who needs to hear this, but guys, earnings drive stock prices. That is what drives earnings growth and drives stock price growth. And the other part is if you are going to hold a stock, if you're a Peloton shareholder and you're down 80%, like, are you willing to stick with that to ride that out? Because I mean, you talk about more broader, like with index, right? The longer you hold it, the better chance of success you get. So I think these are some really great stats, right? Like, it's over the course of from 1926 to through 2019, which is where this data is from. So right before the pandemic, but it still holds true. 1 month time period, you got a 62% chance of making money. 1 year time period, 75% chance of making money. Hold for 5 years, 89%. 10 years, 95%. 15 years, 99.8% success rate on being profitable at the S&P 500. Now you get out to 20 and 30 years, over a 30-year period, the S&P 500 has never lost money, not once. Any start finish date, 30 years, doesn't matter. Never lost money through 2019. The lowest average compounded rate over a 30-year period, 2.6%. So if you pull it out and you're able to stretch it out and kind of zoom out, your success rate is really high. I don't know if I told you, hey, you go to the blackjack table and you sit here for X amount of time, you're gonna 100% chance you make money. Would you do? Would you do it?
Hmm.
Right? That's kind of how I try and frame that, is where if you would just stretch it out, sit in the seat, don't let some of this short term noise, don't let all the the nonsense and all that could distract you from the long-term goal, and just stay put, can stay consistent, and trust the process, then you're going to have a really high chance of success.
Absolutely. I mean, it's the just like in sports too. You think about it that way. The longer you're in the game, the more opportunity you're seen by coaches, the more opportunities that you're giving yourself, the more at bats and the experience that you get. It's a life thing too. It's not only about just staying invested in the long term, but you think about how many times you failed in your life doing something over and over again, and you keep going back to it and you try it and you work on it, you improve. You learn from your mistakes, and so that piece of it too is huge for a lot of investors is you don't have to make that mistake time over time again. You just need to learn from it the first time and continue on your path and continue to not make those mistakes in the future. There's a lot of people that, you look at the 08, 09. I mean, I'll use like my my dad remembers like, man, I thought this was the end of the world. He was like, this is it. Like there's not coming back from it. And you look 5 years down the road and his consistency, he's like, I'm so glad I learned that lesson early on and didn't sell from that position because 5 years down the road, he was in better shape, and didn't really look at that long-term picture. And I use it in the baseball sense. I remember when I was a senior in high school and I had torn my ACL and like the game was over for me, right? I was like, man, this is it. I'm not playing anymore. Like it's done. There is no like coming back from this mistake or this feeling of I am done. But 2 years later, I was good. My body was healthy. I was moving just the way I could, like 100%, felt good. Everything was right. It's that consistency of looking at a graph in life too and saying I can do this and stay with the course, and trust that the process is going to work for me. So that's a piece of it as well. And to your point about, you want to win, you want to stay invested and get the most returns, but winning isn't always everything with it because you have to be set up for that particularly like long term mindset. Very challenging for a lot of people to do.
Yeah, that's a really good point. I think a lot of people get in trouble where they performance chase. There's a really good story. I believe it was Howard Marks talking about a mutual fund manager who he was never a top performer, always kind of in that middle quartile. Very average returns. Never was in the top quartile, which would mean top 25% of returns in his asset class. However, and each year, always kind of very average returns. Never shot the lights out, but never blew himself up. But then over a longer period of time, 10, 20 years, he was the top decile performer, which means he was in the top 10% of overall performance over a longer period of time because he was consistent. Just a lot of singles and doubles, never really swung for the fences, but also never struck out. And I think a lot, kind of going back to, that mind warp that the last 18 months have kind of done to a lot of people who are investors. I would call them traders. They're trying to, it's like, well, if I can't get 10% today, then what am I doing? And that's a completely different game that person is playing, right? If we can just hit singles and doubles over a consistent period of time and not really strike out and not blow ourselves out, then we have a very high chance of success. And that's really where I try and frame the conversation with people is just we don't need to do 30% a year. S&P does 28, great, we'll take it, but like that's not what we need in order to accomplish the goal.
Yeah. And we even put sometimes in our plans like the conservative number of 5 and 6%. If we can plan out for a low and conservative number, you can have success, right? And if we do better than that, great. You're not looking at anything more than that. So that's also a huge aspect of it too. I want to dive into the piece that you had mentioned here about corrections. What that looks like in the S&P, and can you talk about that chart a little bit more as well here?
Yeah, so we'll link to this, but Charlie Bilello, great follow on Twitter if you're interested in looking at some good charts. But we talk about going back to that example, right? Over a 15-year period through 1926 to 2019, over a 99% success rate if you just buy and hold the S&P for 15 years, right? But since that March '09 low, so we're looking at 13-year period, right? Where over that 13-year period, if you just bought the S&P and held, I mean, you're up huge. I mean, it's compounded at like 17% a year annualized. It's been amazing. But to get to that level of success, there's been some ups and downs along the way. I mean, we're talking, you know, 27 pullbacks of 5% or more since March '09 to today. We're in one right now. As of market close yesterday, we're down 7% off the high, right? But out of those 27 pullbacks, 8 of them were 10 plus percent, and the average one was 7.6%, right? And the average pullback lasts about 26 days. So in that short term, you're going to see the wobbles. But as long as you can ride that out and you understand, hey, if I'm being consistent, we kind of talked last episode about automating your investments, right? Like if you know in your head, well, hey, there's going to be at least probably one or two 5+% pullbacks every year. Like it's just going to happen. It's a part of being an investor. Markets do not go up in a straight line. Mentally, if you have that framework and that's where you're operating from, then you're not going to be panic selling and breaking up that compound interest that we talked about. And you're able to ride that out, put more money to work on an automatic basis through a dollar cost averaging plan or 401k contributions, whatever that ends up looking like for you. And that's going to be a very good way to help lead you to success as an investor.
Personally, I've never been a fan of all those TikTok stars out there that are making videos and saying things, and they got, oh, buy this and invest into this and buy my IUL policies and become a part of my team and all right. There's a lot of marketing out there towards things in the finance world that there's not a lot of regulated professionals. They give people like us who are licensed with FINRA and things like that bad names, and it's not something that I would say is a bad thing per se, but it definitely brings a stereotype, and I think that also comes with media and what CNBC and people are saying on those things as well. You look at, let's say, like Peter Maluka, I got a tweet here as well. A return to normal would mean one or more 4,000 point drops for the Dow, right? You look on CNBC and you see a 4,000 point drop, everything's going to be flashing red. Every
Yes.
single thing, right? The panic button, it looks like life is over on CNBC. If you were to tune in and just turn that show on, you would think, what the heck is going on? Like, is this another coronavirus pandemic? Like, but that's the thing about this media and people who are giving you advice on these, social media sites. Everybody wants to talk about it, but as soon as something bad happens, it's hey, panic button. Hey, what can we do? What are opportunities? And that's one thing that scares me a lot, is that people don't always realize that that isn't necessarily a panic. It's a Warren Buffett quote, like, be greedy when others are fearful and fearful when others are greedy. A very simple idea, but when markets are down, that's a great opportunity for you to buy. And you had talked about too a little bit, cash, right? Having the opportunity with cash to buy in and get into those lower prices. That's part of dollar cost averaging and being in a good spot, to prepare yourself for things like that, because it is very normal for corrections to happen.
Yeah, absolutely. And with cash as well. On the flip side of that, with savings accounts, I posted a chart yesterday on social media talking about the nominal versus real, which is inflation adjusted returns, right? And interest rates are extremely low. Savings accounts are getting you 0.03% interest annual, right? But so savings accounts are just savings. They're not investing, right? In a savings account, net of inflation, you're losing money. But you got to have that in place, that emergency fund, right? That we've talked about, and that most financial professionals are going to tell you need to have that 3 to 6 months expenses. Just having that cash on hand, because guess what? March 2020, market down 30%, 33%, 35 at the worst, right? A lot of people lost their jobs. A lot of people lost their stream of income. Now you can get hit with that double whammy where, okay, lost the income, still got bills, still got rent, mortgage, whatever to pay, right? Unemployment ended up coming and in a big way and helping, but that wasn't a guarantee at the time. So then you can get hit with this double whammy where it's like, hey, I need cash. I need to shore up my cash reserves, and I'm selling stock down 30%, right? Where now you're getting hit with the double whammy. Lose your job, need cash, selling out of the market, in a bear market, down huge, breaking up that compounding. And that's how you can really get yourself into trouble and really blow up a lot of your returns over the long term. So at the end of the day, like, first things first, you got to get your cash in order. You got to make sure you have money to fund your day to day before we start thinking about putting money into the market. Like, that's kind of that fundamental step before we even talk about getting into the process of investing. Like, the first step in that process is getting your personal day to day expenses in order and having that cash buffer, and then we can go to start talking about investing, because we do not. That is worst case, right? Absolute worst case scenario where we lose income, we need cash, we're selling in a down market, and now we're really blowing ourselves up as far as investment returns over the long term.
Yeah. And kind of switching gears a little bit for you. I mean, was baseball a driver for you in investments? Did that change the way you thought about investing at all?
Well, yes. So it's funny that you mentioned that because of what I just said. Professional baseball, especially at the minor league level, don't make a lot of money. So I was actually using my investment gains. I had a very different approach. I was much more I had my kind of my steady index funds, I had a couple index funds, ETFs, some longer term holds, but then with a second account, I was trading it. And I would live off of the trading profits, because that was how I supplemented myself,
Sure.
for my income. So I was actually really kind of hurting myself. Like, if I wouldn't have had to take money out of that account to live off of, my net worth would be much higher. But I had to break up that compounding and had to, be more in and out of the market with individual stocks, because that was the game I was playing at the time to fund the lifestyle, because that was just how it worked. Now, as a normal person, a NARP, a non-athletic regular person, I I don't do that. I don't jump in and out of the market. It's pretty much buy, hold, accumulate positions over time, because my reality has changed, and I have more flexibility to be able to do that. But during baseball, my approach was a lot different, just because of the circumstances I was in, and it was a lot more difficult to kind of run it up, and I had to live off those trading profits, which was good, because we'll link to this chart. But if you notice, there's 1 year since 2009 that did not have a 5% correction, and that was 2017, which is right in the middle of when I was doing all that, which was great for me because it was just like straight up and to the right on everything. So that was great, but that's not normal. I just got very lucky when I happened to be doing that type of trading and that type of strategy.
Yeah, and some people get caught up in it and they quit their job and become a day trader and they look back at it and they make that mistake. So I'm glad you didn't and you stuck with baseball and enjoyed it, right? It's very interesting to hear the perspective from you because so many athletes get involved with either business or sales or investing. There's a lot of financial advisors that come from baseball. And I think there's so many commonalities between the ideas of discipline and uh, consistency and how mental of a challenge it is to play the game of baseball. It ties right into investing, right? Your mental aspect when you see the market drop, boom, you're going right to what do I do, right? Your mind does. It's just a natural thing. It's not something that you can control. And the same thing goes for the game of baseball, and that's why I see so many athletes, young and old, get into the game of business and why they can have success in it is because they've gone through it, not necessarily directly, but they've had the experiences of failing. And like I mentioned earlier in the show, there's just so many pieces of this game that I think teach so many valuable lessons that you don't realize. Is there like one or two things from the game of baseball that like made you think, wow, I can really get into business, I can have success in my afterlife of playing the game at all? Like
Yes,
any
I
examples?
I always tell people, be like, "Is this what you want to do for the rest of your life?" Like, when they ask me, "Are you going to be in finance, as a career?" I'm like, "Yes, I was built for this. Like, I was built for this." And I do think that my experience playing ball, 100%. prepares you for a life as a professional investor. Baseball is a game of failure. You know, I was on the pitching side, so I actually didn't have to fail quite as much. But like, if you're a hitter, you were a hitter, right? Like, if you're like the goat, like you're just unbelievable. You hit 350. You're still failing basically 2/3 of the time, right? And you're still willing to mentally be okay with that, accept that, just knowing that, hey, I have to be right 1 out of 3 times, right? If I get this one right 1 out of 3 times, I'm the best player on the field,
Mhm.
right? And for me, you know, even as a pitcher, it's like you can do everything right. I can pan a fastball at 95 on the outside corner, and that guy still might get to it and smash a double off the right center field wall. Like that can happen. That'll happen. But um, so that part, just being able to accept failure, not get down on it, and be able to continue to push through, definitely is a huge part of it. Because you know, investing, if you are going to play the individual stock game, if you're not just going to buy index funds, if you are going to play the individual stock game, you know, you got for every 100% winner that you have, you also got to have an answer for that 30% loser, especially on the professional side. You know, I talk with our two portfolio managers about that. It's like, hey, you got to be able to answer for every single holding in that portfolio, good or bad, right? So I think that's a huge, and baseball is a great teacher of that. And then the second takeaway is baseball is every day. It is not football. You don't play that thing once a week. You play every day. 100 in the minor leagues, 140 games and like 160 days. You know, big leagues, it's 162 games and it's like 183 days. Like you are there every day, good, bad, indifferent, doesn't matter. You're showing up and you're going to work. So, and that's very similar to the investing game. Don't stop. Does not stop. 5 days a week,
Mhm.
except for holidays. Like it's continuing to go. If you're in the crypto space, that's 24/7, 365, right? So, I mean, you got to answer the bell literally every day, 8:30 a.m. here in Central Time. That bell rings and you answer that bell every single day.
Yeah, it's about discipline, and that's one piece that it was instilled in me at a young age, and I'm grateful for because there's so many people out there that aren't disciplined to their life. And we've talked about this in the goals episode, in the previous episode about what it takes to stay consistent with what you're doing. That's a very challenging thing. So, with all of that said, there's so much great things involved in the process. One thing that Jonathan and I really like, and why we bond so well, is that we're both process guys. But Jonathan, one final question before we wrap up is, what do you need to do to get into this? What process and what steps do you need to take to start investing and getting into the idea of, hey, I can do this for a long term?
Oh man, I think it starts with the goal. You know, we talked about goals last week and just trying to, you got to figure out what you want. Like, what do you want to do? Right? Money is a tool. So it's like, what do you want to do? What do you want to accomplish with the tool? And then from there, once you kind of have an idea of what you actually want, then it's just start. Really, it's just, I mean, the barrier to entry to investing is as low as it's ever been. Free trading, discount brokerages. I mean, you can open a brokerage account in 5 minutes at any broker, right? Robinhood's obviously very popular. Schwab, TD, Vanguard, Fidelity, whoever. If you want to use a professional, there's thousands of professionals out there that would be very willing to help you. But you know, once you get that goal, once you kind of figure out what that you want to do it, then just do it, right? Put some money to work. Whether it's I always recommend starting out with index fund. You know, just buy the S&P 500, buy VT, right? Buy the Vanguard Total Stock Index. You get the whole, you get every stock, all
Mhm.
3,000 something of them for like 5 basis points. Like just start there, just buy, right? Figure out how much 10% of your income is, and just put that much money into a couple index funds. That's the easiest way to start. And then as you get going into it, then if you have more complex situations, rollovers, whatever, you know, job change, whatever it is, then that might be a time for a professional to seek professional help. But I mean, you just got to start, do a little homework on the internet, figure out which brokerage firm you want to use, and just start. That's the biggest advice I can give to anybody that's thinking about doing it. If the question is, should I invest? The answer is yes.
Yeah, 100%. Well, great. We appreciate the time today from all of you that are listening here, and everything that you have said today, Jonathan, is so important for us to listen to and learn from. So, if you have questions, feel free to reach out to one of us. We're always happy to help. Thank you again for tuning in to the Next Gen Leadership Podcast, and we'll see you soon.
This material has been prepared for informational purposes only and is not a solicitation or an offer to buy any security or instrument or to participate in any trading or distribution strategy. Past performance does not guarantee future results. The accuracy and completeness of this information is not guaranteed and subject to change. Waterfront Wealth Inc. and Exeter Wealth Inc. are currently registered as investment advisors with the Securities Exchange Commission.